Hi, my name is Alex Fensky, and I'm a real estate problem solver. And in this video, we're going to talk to you today about what a loan modification is, talk about a few different types of loan modifications, and how you can apply for one. So first off, a loan modification is an option that's available to people who are having trouble paying their mortgage. So something has happened, you've lost some income for one reason or another, and you're either behind or you're about to fall behind on your mortgage payment. A loan modification is a temporary or permanent change to the terms of your loan to make it more affordable for you. So ultimately, it's an alternative to potentially foreclosing on the home if you're otherwise unable to pay the monthly payment on it. So this is a product that is available for people who typically are occupying the home. I don't see a whole lot of these happen on investment properties. I'm not saying it's out of the question, but I actually haven't seen one myself. So it's typically something that banks will do for someone who occupies the home as their primary residence, and for somebody who wants to keep the home. If you'd rather sell the home, then there are other options for you. So this is primarily for owner occupants who want to keep the home and stay in the home. So let's talk a little bit more about who qualifies for loan modification. So there's really two big ingredients to this. Number one, you have to have a documented hardship. And what the banks consider a hardship might be different from what you consider it to be. There has to be some kind of verifiable loss in household income. Typically, that has to do with whoever's name is on the loan. So, if that person has become disabled and they've lost job income, or their hours were cut permanently or maybe temporarily, or maybe they were laid off and unemployed for a long time, maybe they had a forced relocation for some reason, death or divorce, things like this are what the bank would consider a documented hardship. So that's ingredient number one, is you got to have that. And ingredient number two is you have to be able to make payments. So if someone says, hey, I've lost my job, I don't have disability income, and I'm never going to work again, I do not have income and I never will, the bank is not going to approve a loan modification because, okay, they can go to all this trouble and modify the loan, but if you still can't pay it anyway, you're going to end up back at square one. So you have to be able to show them that you'll have an ability to pay the loan in the future. So what sort of changes are possible to the loan? I said this is a temporary or permanent change to your loan terms. So the first and most common one is they could potentially change the interest rate, which of course changes your payment amount. If your mortgage is at 5 or 6%, and they say, okay, we're going to reduce that interest rate to 2%, it's going to drop down the monthly payment amount. And that's probably the most common type of loan modification that we see. Number two is they could change the term of the loan. Most mortgages are written on a 30-year term, and so that stretches out the balance that you're paying over the course of 30 years. One of the types of loan modifications we see is they might extend that to 40 years, which again has the effect of reducing your payment. Instead of, maybe you're 3 or 4 years into it, instead of having 26 or 27 years left to spread that balance out over, you're gonna spread it out over 36 or 37 years. The last type of loan modification that we often see is where they're just going to change the principal balance. Now, don't be fooled by this one, because this is really something that I run into a lot of people that misunderstood what happened. So let's say that you're behind on payments and you're $20,000 behind, and the bank says, well, we'll do a loan modification and we'll sort of just take that $20,000 and we'll wipe that out. People think that the $20,000 just sort of evaporated. Well, there's one thing banks aren't real fond of, and that's losing money. And so the bank is not just going to take your 20 grand and kiss it goodbye. Here's what they typically are doing. They're usually, in this case, working with HUD, the Department of Housing and Urban Development, especially on an FHA or a VA loan. They're saying, hey, HUD, this is an FHA loan. FHA is HUD. You insure this loan. Your borrower got behind here. They're behind 20 grand, and we'll work out a new plan with them if you'll pay us the 20 grand. HUD steps in and pays whatever you were behind, but then HUD records a lien on the property for that amount. Now, there's no interest on this. There's no payments. So if it was $20,000, it's never going to be a different number than $20,000. But anytime you go to refinance or sell that home, that $20,000 is going to have to get paid for. So in the event of a loan modification where they're going to clear a delinquent balance for you, just know it's probably not going to get just erased. It's probably going to get paid by another entity such as HUD and stuck onto the property as a lien that you don't have to pay for in the meantime, but you'll have to pay for if and when you sell or refinance the home. So that's the third type of common loan modification that we see. Let's talk about now, how do you go about this? What would you do if you say, hey, I meet these criteria. I have a financial hardship, but I'll be able to pay something, just not what my payment is right now. So if that's the case, number one, call your lender. Call your lender, or even just sign into the website. These days, almost all lenders have a prompt right when you sign in or right when you call that says, if you're having trouble paying your loan, press whatever button. Or if you log in, it says, if you're having trouble paying your loan, click here. Most of them have that really front and center. If you've never noticed, it's probably there. You just weren't looking for it. So that's number one. This is the only way that you can begin the loan modification process, is to contact your lender first and tell them that you're having trouble. At that point, they'll give you your options. And they'll probably talk to you about a loan modification or a forbearance. A forbearance is a type of loan modification where they say, hey, we'll let you not make a payment for the next 3 months or so. Maybe if you're out of work temporarily, but then you got to start right up after that. So they'll give you your options, and they'll give you a packet of information. This packet is actually a lot of work. It's basically everything you would have to supply if you were applying for a new mortgage. You got to give them even a little bit more. Pay stubs, tax returns, you got to fill out a budget worksheet for them. You got to tell them about any other household income that you have from others that are in the household. So there's quite a lot of information that you need to complete for them. You need to be very careful that you fully complete all of it, because one challenge with the loan modification process is it can take a long time. Meanwhile, your payments might be late, you're getting damage to your credit, you're worried about foreclosure. So I'd encourage you, when you fill out these loan modification packets, really do a thorough job and make sure you're giving them everything they need. Otherwise, you might wait a few weeks for them to get it and review it, and they go, oh, you're missing this thing, and they kick it back, and now you've restarted the clock a few more weeks. So they're going to give you a packet of information, fill that in, and they'll probably go back and forth with you to talk about what you can afford, make a proposal. Eventually, hopefully, they'll say, okay, here's what we are proposing to do to modify your loan. That's where they're going to spell out the terms of what the temporary or permanent modification would be. And when they do that, you can say, okay, let's proceed. They'll usually have a 90-day trial period where you got to make 3 payments on time of whatever the new payment is. And then they'll say, okay, great, we'll lock this in. We'll do a permanent modification. But if you miss one of the 3 payments during the trial period, usually they're not going to grant that modification, because they go, well, hey, you need to be able to pay something. This is what we're willing to take on a monthly basis after this. And if you can't do that in the first 3 months, then we're not going to do that. We might end up wanting to move forward with a foreclosure. So it's really important during that trial period that you make all 3 of those payments on time. If you're lucky enough then to get through that and get the permanent loan modification, then again, that's permanent, as long as that was their offer or agreement with you. Just remember that if there was any kind of a balance that was wiped out, it probably wasn't wiped out, it's probably still there. So with all that said, the summary of all this is, if you are an owner-occupant and on your primary residence, you're either behind or close to becoming behind on your mortgage, and you'd like to keep the home, then contact your lender and tell them, I'm having trouble making my payments. Now, anything that happens after that or any questions, feel free to contact me or like and subscribe below for more videos and information about what you can do when you're undergoing any kind of financial hardship as it relates to your real estate. And feel free to reach out. We'll be happy to answer any questions that you have. Thanks a lot.